Hello students, welcome to all of you Shiksha 360 CAP classes. In this session, we have to discuss the part 5 of ABFM. After that, one part will be left. We will cover that. Clear total 6 parts. In the 6 parts, we will cover this chapter along with the MCQ discussion. Let's start. So this session, it is totally related to the term loan. Clear? So this session, it is totally related to the term loan. So now let's start. I think all of you are very well aware regarding the term loan also. So now let's start this session. So this is another major source of the long-term finance. Clear? So term loan, basically what is that? This is one of the source of the long-term finance. So this is another major source of the long-term finance by which a company can obtain the term loans from the banks or financial institutions. Clear? So that is term loan basically from where they can avail, basically from the banks or the financial institutions. While banks also giving working capital finance, clear, while banks also giving working capital finance, the financial institutions are allowed to give only such loans which are repayable over the years as per the terms and conditions of the section. Here, the financial institution, that is along with the banks, that is financial, that is while banks also give working capital finance, clear, the financial institutions basically are allowed to give only such loans which are repayable over the year, like 7 years, 10 years, clear, as per the terms and conditions, clear, of the sanction. So this source, it is different from the equity, clear, that is we have also discussed that is how they will raise the funds by issuing the shares, clear, through equity. And this is the different source, clear, that is from banks, clear. So this source, it is different from the equity and relatively cheaper to the service. So the equity forms are either a permanent source where repayment it is not there, or a very long period like 20 years is available for the repayment. Clear? Or 20 years or a very long period like 20 years is available for the repayment, or in the case of the preference shares or capital. Clear? So term loan, basically generally term loan, it is to be sanctioned for the long time periods. So term loan basically can be for long to medium terms, stretching to about 10 years, clear, stretching to about 10 years, clear. Sometime in the examination, like what are short-term loans, that is less than 1 year. Okay. So this is the basic definition, that is for the long-term finance. Which type of the loan we have to take here, that is a term loan, clear. Term loan, it is to be taken for the long-term finance. Now move to the next point. So the term loan may not be a costly, clear, the term loan may not be a costly as a source of finance as taken working capital finance, because rates are determined based on the medium to long-term prospects of the project, where cyclical movements in the business fortune are more or less evened out. Generally, term loans are resorted to finance setting up or expansion of the projects. Clear? So they are saying that basically on the term loan, basically there is a difference between the rate of interest also. Clear? As per the time period, clear, there will be a rate of interest difference, clear, for the period. So now we have to discuss what are the features of the term loans one by one. Okay. Like even you will find that clear on the term loan, if the loan is as per the government schemes, under many government schemes, if the term loan it is going to be, we can say that you are paying the installments properly, so you will also get a subsidy. Here there is a good amount of subsidy also available on the term loans, clear. But the main condition, that is if your repayment process it is going to be good, clear. This is one of the main conditions under that. So now move to the further. All loans except the demand loans are the term loans, clear. All loans except the demand loans are the term loans and are generally granted for a short terms to the long terms, clear, and generally granted for short term to long terms. Short term loans basically are repaid within a year, clear. Short term loans basically are repaid basically within a year, which I have already discussed, that is, and a long period. it is a period from clear, and a long term period basically it is a period from 5 to 10 years, and medium term it is a range from 1 to 5 years. Clear? Short term less than 1 year, medium term 1 to 5 years, long term 5 to 10 years. Clear? So this is the period. Clear? So what is the meaning? That is, this is the period in which you have to repay the amount. Clear? So this is the period within which the loans are to be fully repaid. So loans granted for housing are generally for the longer period. Clear? Like we are taking the housing loan. So that is basically generally for the longer period, like 25 years, 30 years. Clear? That is the way. So loans granted for the housing are generally basically for the longer period ranging from 5 years to 30 years. Clear? That are ranging from 5 years to 30 years. Now move to the next point. First of all, we have period discussed basically for how much duration the loan is to be taken. Next one basically for what type of the purposes. Clear? So what type of the purposes the loan is to be taken here. Clear? So now let's discuss regarding that. So the term loans are granted. Clear? So here the term loans are granted to acquire the assets. Clear? The term loans are granted basically to acquire the asset like land. For what purposes basically we are taking the term loan? Basically to acquire the assets like land, building, plant and machinery, to establish a factory. Clear? Plant and machinery basically for what? To establish a factory, or to set up a project which are tangible and have a very long useful life. Clear? Or to set up a project which are tangible and have a very long useful life. So for the reasons such as a long gestation period, slow start. Clear? Like if you are establishing a factory. Clear? So it will take 2 to 3 years. Clear? And after that, where in the starting you will get very low cash or basically very low earning. Clear? As the process going on, you are earning sufficient amount from that. Clear? So this is the same thing they are saying here. So for the reasons such as long gestation period, slow start to cash generation cycle, and a longer life, a longer period it is granted for the repayment. Clear? That's why basically they have longer period for the repayment. If the project it is already running, clear, on the other side, that is if the project basically it is already running and the loan is taken for a capacity buildup, clear, and the loan is taken basically for a capacity buildup. So a shorter period up to 5 years will suffice as sufficient, we can say that, as cash flows are already there. Clear? That is because here second condition, that is if the project is already running, clear, that is your business is already going on. Clear? So in that case you will get less shorter duration of time because you have already earning sufficient time from that, sufficient income from that to repay the installments. Clear? Basically for what? To repay the installments. Short to medium term loans are preferred. Clear? Generally basically short to medium term loans are preferred for other tangible assets such as computers, peripherals, furniture, renovations, etc. Clear? Loans are also granted for the housing and soft furnishing. Clear? Loans are also granted basically for the housing and the soft purposing. Clear? So all these things basically comes under the purpose. Clear? All these things, that is basically for what purpose you are taking the loan here. Okay, so we are discussing 2 points here till now. What is the period of the loan and what is the purpose of the loan? Clear? So next one, what is the interest? Clear? Interest on the loan. So term loans generally carry a fixed and predetermined rate of interest. The rate to be charged is negotiated and depends upon the period. Clear? So the rate is to be charged. Clear? Why? Basically that is because it is a long-term loan, like we can say that 20 years. Clear? So the rate is to be negotiated here and depends upon the factor like such as period and the capability. Like we have to take in the like CIBIL, CRIF reports. Clear? So what is the capability of that? We are taking the risk under that. On the basis that if any person is a CIBIL or CRIF, it is low. So that is there is more risk under that. So if there is more risk under that, so bank will charge higher rate of interest. Clear? So bank will charge higher rate of interest. If there is CIBIL and CRIF or other credit rating, just I am taking an example, it is high. So it means that financial records of that person, it is to be good. Yes, it means that if the financial records is good, so less rate of interest is to be charged here. Clear? So that less rate of interest is charged. Okay, so kindly remember these things. Clear? So interest. So term loans basically carry a fixed and predetermined rate of interest. So the rate to be charged, it is to be negotiated and depends upon the factors such as period, risk rating of the borrower or credit worthiness, as well as the purpose. Clear? As well as the purpose. So further, that is interest is to be payable. Clear? That is interest is to be payable either monthly or quarterly, and sometimes it is embedded into the equity monthly installment. Clear? So here interest which is to be payable either monthly or quarterly, and sometimes it is embedded into the equal monthly installments. Clear? Equated monthly installments. Generally, it is to be say that which combine both interest and principal. Clear? That basically, or which combines both interest and principal. So in certain regulated sectors, clear further, that is in certain regulated sectors, there are floor and ceiling rates of interest prescribed. Rates also depend upon the market conditions. Clear? Rates are also depend upon the market. Like you will see that at the time of the COVID, clear, there are a lot of decrease in the interest rates. Clear? But continuously you will see that from the last 1 year, I think from the May 2022, there is continuously increasing the rate of interest, and I think approximately 2.5 to 2.7%. There is the increase in the rate of interest basically from last 1 year. Clear? Not from last 1 year, basically from the last 8 to 10 months. There is a lot of increase in the rate of interest here. So we have to take care, basically we have to understand regarding all the things. Clear? This is the same thing they are mentioning here. So in certain required sectors, there are floor and ceiling rates of interest are to be prescribed. So rates are also depend upon the market conditions and the competition. Sometimes the relationship with the borrower and the business future business opportunity. Clear? Sometimes the relationship basically with the borrower and the future business opportunity are also taken into account basically while determining the rate of interest. Clear? Sometimes the relationship basically between the borrower and the future business opportunity are also taken into account. Clear? That are also taken into account while determining the rate of interest. Clear? That is while determining the rate of interest. So three things we have discussed, that is, first of all, what is the period of the loan? Second one, that is what is the purpose of the loan? Third one, what is the interest on the loan? Further, penal interest. Clear? So penal, what is the meaning of penal? That is penalty. That is if you are not paying your installment or paying the amount on the time, so you have to pay the penalty. Clear? Along with the interest. Okay, so along with the interest here, you have to pay the penalty. Clear? So penal, additional or higher rates are generally provided. Clear? Penal, that is additional or higher rates are basically generally provided for delays beyond the agreed repayment period. Clear? Basically for what? That is basically for the delays beyond the agreed repayment period. In case moratorium, it is granted for the repayment of principal. Clear? In case moratorium, basically it is granted for repayment of the principal. Moratorium, what is the meaning of the moratorium? That is like we can say that basically for the establishment of the factory, clear, first 2 years, then we can say that first 2 years they will not ask any installment. What is the meaning of that? They will not ask any principal repayment first 2 years, but at this time you have to pay the interest. Clear? You have to pay the interest. That is in the moratorium, you have to pay the interest. Clear? So this is the same thing, that is a time like you are taking the housing loan. Okay, so at the starting, like you are building, you are constructing your house. So basically, along with the loan amount, there are also amounts spending upon that. Clear? So like we can say that in the housing loan, like they will give you 24 months moratorium. That is after the 24 months, that is after you are taking the loan, after 24 months, your installment will be start. In the meanwhile, you have to pay just interest. Okay. So in case moratorium, it is granted for the repayment of principal. Clear? For the repayment of principal. So interest, it is to be required. Clear? So here just what is that? Interest, it is to be required to be paid as per the schedule. Clear? So in this case, basically interest is required to be paid as per the schedule. Whether the interest it is paid separately or embedded in EMI. Clear? So whether the interest further, that is whether the interest basically it is to be paid separately here or in embedded in EMI. The interest keeps reducing depending upon the outstanding principal amount due. Clear? So the interest it is to be charged on which amount? On the principal amount or on the remaining amount. Clear? So the interest here, it is to be charged on the remaining amount. Clear? So here the interest it is to be charged basically on the remaining amount, not on the principal amount here. Okay, so these are how they will ask these things in the examination. These things basically will be asked in the examination in the form of the case studies. Clear? In the form of the case studies. Clear? So they will take some points, they will take like different points, clear, from all these topics, and you have to answer the question in that way. Okay, so kindly remember these points according to that. Now move to the next point. Repayment. Clear? So what is the repayment? That is, so loans are generally here repaid over the granted period and generally in the installments. Installments, that is basically like in the case of the, if you are taking any agricultural equipment, clear, agricultural equipment. So in that time, the installment period, it is to be quarterly or half yearly. Clear? Depends upon the production. Okay, so it depends upon case to case. Clear? So which are to be monthly? Clear? Installments either to be monthly, quarterly, half yearly or yearly. In some specific, but time in some specific, basically, but time bound acquisition of assets, there is a recovery by bullet payment in one shot. Clear? Bullet payment, that is all the payment it is to be done in one shot. That is at a one time. Like you are taking, just for an example purpose, not here, like you are taking the loan against the fixed deposit or gold loan. So in that case, there is a facility that is you have to pay or you have to repay the amount basically in one shot. Clear? Repayment the amount basically in one shot. Clear? So moratorium here, that is moratorium basically it is granted for the principal repayments where projects are large and cash generations are likely to time taken. In cases like the EMI, the financial burden it is eventually spread out. Clear? In cases like EMI, the financial burden basically it is evenly spread out through the interest component gradually goes down. Clear? As in the EMI, you will see that basically at the starting point, in the starting phase, there is more interest in the loan installment and there is less principal. Clear? As the time passes, the interest amount it is going to be reducing and the loan amount, and the principal amount it is going to be increasing under that. Okay? And the EMI amount it is to be fixed here. So from every installment, the accrued interest, the charged interest basically it is carved out first, and the remaining amount basically it is a portion towards the principal. Clear? And the remaining amount basically it is a portion towards the principal. Clear? So what is that is first of all they will take the interest from you. Clear? That is interest from you, and later on the principal basically will be taken from that. Clear? Later on the principal basically will be taken from that. Okay. Now move to the next one, currency. So in many large projects, clear further, that is in many large projects, the import component of the assets, it is quite large, where the loans are to be granted in the foreign currency to facilitate proper requirement. Clear? That is you are taking machinery from any foreign country. So that is you require the money in that currency also. Clear? So in many large projects, the import component of asset, it is quite large. So where the loans are granted in the foreign currency to facilitate the proper requirement. Since the quotations are in foreign currency denominated, and by the time the actual import takes place, the INR element may be a different amount. Clear? Because it will take a time. So in the meanwhile, the rate of the currency, that is currency conversion, it has to be changed here. Clear? Foreign currency. Clear? The currency conversion, it has to be changed here in the meanwhile. So repayments are also done in the foreign currency, where the borrower buys a foreign exchange from the market at the then prevailing rates. Clear? So in that case, the repayment is to be done in the foreign currency also, not in the Indian currency. Clear? That will lead to the loss. Clear? or profit dependent upon the case to case. So in that case, in which thing basically, or basically in which currency they will repayment, that is in the foreign currency. So therefore, although the rate of interest may be a bit lower due to the international rate structure, the cost of clear, although the rate of interest clear. So although the rate of interest basically may be a bit lower due to the international rate structure, the cost of actual repayment clear. So here that is the cost of actual repayment may be higher clear. The cost of actual repayment basically may be higher. So in such a case, the borrower is advised clear. Basically in such a case, the borrower is advised to enter into a forward contract to hedge the risk clear. To hedge the risk basically means that to protect the risk clear, that is to protect themselves basically from that risk clear that they will face basically from the amount conversion clear, that they will face basically from the amount conversion clear. So kindly remember this thing here clear. So in such a case, the borrower is advised basically to enter into a forward contract basically to hedge the risk clear, to enter into a forward contract basically to hedge the risk here. Okay, so that is regarding the currency. So kindly remember these points clear. Kindly remember this point. These are very, very important clear. These are very, very important for the examination point of view. Now move to the next one. Security clear. So what is the security is to be taken by the different financial institutions? Okay, so uncertainty, that is sometimes the borrower it is not able to pay clear willingly or due to some other reasons clear. So uncertainty over a longer period obviously enhances the risk perception clear. Uncertainty over a long period obviously basically enhances the risk perception, and so also insecurity in the mind of the lender clear, and so also insecurity basically in the mind of the lender. So even otherwise no lender can or will lend clear. Otherwise no, even otherwise no lender can or will lend without securing the term loan clear, without securing the term loan by creating charge over the primary assets clear. So even otherwise basically no lender can or will lend without securing the term loan by creating charge over the primary asset, that is the assets purchased clear, that is the assets purchased through the term loan clear. So they will create the charge over that. In the case of the failure of the repayment, they will take amount from that clear. So sometimes collateral securities clear, basically sometimes collateral securities are also obtained which generally comprise of personal assets of the promoters, especially to keep the promoters highly committed clear. That is they will take the personal, like we can say that house or any factory building clear. So tangible securities are always preferred clear, tangible. So a proper and independent valuation it is to be carried out by the lender. Titles to the mortgaged assets and liquidity or saleability basically are also examined clear, or saleability are also examined, that is who is the actual owner of the building, that is, and what is the value of that clear. So all these things are to be we have to be take care clear. So all these things we have to be take care. Okay, so that is regarding the security and the amount of the loan clear. So next one, that is what is the amount of the loan. So in case of purchase of existing assets, clear, basically in case of purchase of existing assets, so the lender carries out an independent valuation, clear. So in the case of purchase of existing assets, the lender carries out an independent valuation and after providing a margin, clear. So in case of purchase of existing assets, the lender carries out an independent valuation and after providing a margin to cover value fluctuation and borrower's margin or contribution, the loan amount it is to be determined, clear. So in case of purchase of existing assets, the lender here basically carries out an independent valuation and after providing a margin, clear, further that is, and after providing a margin to cover the value fluctuation and borrower's margin, clear. Like we can say that if the machinery it is of 1 crore, clear. So the bank will borrow, basically the bank will lend like 90% or 85%, clear. As there is a borrower margin or contribution, the loan amount it is to be determined. So in case where the term loan basically it is creation for the fixed assets by the borrower, so the loan amount it is to be arrived at by the debt or equity ratio basically as decided by the lender, clear. So in that case, clear. So in that case, basically the loan amount it is to be decided, clear. Basically in that case, the loan amount basically it is to be decided or the arrived at the debt or equity ratio basically as decided by the lender, clear. At the debt or equity ratio basically as decided by the lender. Okay, now move to the next one, that is the appraisal. So the appraisal process of a term loan, clear. The appraisal process of a term loan by the lender, clear. So appraisal, that is the appraisal process of a term loan by the lender, depends upon the size and complexity of the project finance, clear. So the appraisal process of the term loan by the lender, clear. The appraisal process of the term loan basically by the lender depends upon the size and complexity of the project financed. However, no term loan is to be granted, clear. However, no term loan basically it is to be granted without examining the economic viability and the technical feasibility, clear. So however, no term loan basically it is to be granted without, like we are saying that basically we are giving the loan but not checking properly, clear. So where they will utilize the amount, clear. So whether that project it is to be useful in the market or not, clear. So these are the things we have to be take care here also, clear. These are the things which we have to take care here also. Okay. So in this session, we have to be discussed up to this much point, and only one point it is left in the session, that is the regarding the debentures, which we will cover in the next session along with the MCQ, clear. So only debenture basically which is left, which we cover in the next session, and after that this topic it has to be completed here, clear. So I request to all of you kindly go through all the points properly, whatever we have covered. In the next session, we will cover all these things along. We will discuss some of the MCQs in the next session. Okay. So thanks to all of you for going through the topic, that is term loan.